We are in the fifth and penultimate hour of the Hidden Pivot course, and we're looking at a chart that summarizes not just the fatal flaw in Lindsay's trident that we talked about earlier, but a way of getting around it and even using it to our advantage. But I've suggested an exercise whereby you would come to your trading screen on a given day and take the first signaled entry of every attractive ABC pattern you find. And then on another day, you simply let that entry opportunity go by, and you take the second signaled entry opportunity. The more you do that, the more finely calibrated your sense of opportunity will become. Let me say that the machine trading of ABC and 1, 2, 3 patterns has become so prevalent that it's almost become a given that if you got what I used to teach as a beautiful, perfect ABC pattern, it's almost always going to fail. So we're really going to have to use corollaries to what we're learning to make good use, best use of these ABC patterns. And to do it most aggressively, you would look at an ABC pattern where your ordinary response would be to get long and say, I'm going to short it. Everybody's getting in here, and this thing's just going to stop them out by going below that real obvious low that they're all using as to place their stop loss. So you might even try that as an exercise on a third day to look at every beautiful ABC rally pattern, and instead of getting long in the way that you've been instructed to do to get long, to short the pattern, to short it at its P or even its X. All right, this is another page that I want you to come back to when you've seen what all of these points allude to, and I want you to sort of it's a visual exercise. I want you to picture each one of these things and kind of figure them out in a visual way, because I think that's the best way to come to understand them. But let's take a look at the pictorial side. This is a sequence of slides that shows the thought process involved in framing a pattern and coming to it in a way that makes it actionable. We're looking at a chart of Newmont, and it's been in an uptrend, and let's say we're bullish on Newmont anyway, and we would like to buy it. Well, one of the little tricks that we know already, or one of the I won't call it a trick, but something, an idea that we know already, is that rallies, dominant bull trends, tend to produce corrective ABCs that don't reach their targets, but which in fact reverse from the P midpoint. So if we're looking to buy Newmont, we couldn't ask for anything better. We've got this corrective A, B, C, and all we need to do is step in and buy it there speculatively, because it's a good, nice rally in Newmont, and we should expect a corrective ABC to reverse from its P midpoint. So we've got a good buying point. But do we? For starters, what I've just called an ABC pattern isn't really. We've got a stick up high there and a nice stick down low, but it really didn't meet our rules. It didn't meet our criterion because it only got past one external low and no second low. It only got past a single prior low right there. Not only that, but we would prefer to have a one-off A to work with rather than this good sharp one. So it's missing a couple things that we would like to see to bring order and perfection to an otherwise a so-so chart. So we come down to the 5-minute chart, and this opens things up a little bit. It puts some more bars on the chart. For one, now we can see that the downtrend got past an external low there and a second one there. So it does qualify as an impulse leg. According to our rules, it got past 2 prior lows. And it has a kind of one-off A right there, but not quite. It looks like it might want to be one, but it lacks a stick-down bar before it. We've got this stick-down bar, but it relates to this high right here not to this one. So as much as we want to make that a 1-off A, we're not quite there, because even though it sticks up real nice, it doesn't have a stick down bar before it to define it as a discrete high. So let's try dropping down a little bit lower on we're on the 3-minute chart right now, and this gives us pretty much everything we need. We've got a nicely drawn 1-off A right here, and we've got a good swooning impulse leg down to here, and it did get past one internal, one external, and a second external, and it did so. It got all the way from there to there without any intervening corrections. You might say, well, what about this bar here, Rick? Isn't that corrective? Isn't that an upward correction? But we see that it's really not a true peak. It's not because there is no low preceding it that sets it off as a high. So we can, and for that reason, we can read everything from that high to that low as an unbroken, unpaused, uncorrected AB downward impulse leg. And by the time we get up to here and start to fall a little bit, we do the calculation. We plug in our beautiful A, B, and C, and it gives us a P right here. And trust me, you're going to want to get in there at 58.72 with an aggressive bid and just test the water. It's a good place to speculatively bottom fish. One thing I mentioned earlier concerning P midpoints that I fall in love with, if they're in the middle of the ocean. In this case, not quite. If we look to see where P is and we go to the left, we see there are a couple minor lows here that other traders might be looking at as places where we would pick up some support here. But most traders won't really consider these lows as being that important, and that's why I think we can use P. And also, it makes a difference in our favor here if the P is not exactly coincident with either of these lows, but it looks like it's actually beneath that low right there. So in that respect, or for that reason, any other traders who are looking for this low as a possible test of support, they've been stopped out down here because this P has exceeded that low by a few ticks. So we like that. We like a P that captures the panic of traders getting stopped out, but it does so with a precise price point that we can use to try to go long against the trend. All right, we're going to put it all together here and talk about camouflage. I did promise you that once you'd come this far, you knew about 90% of what you need to know. You probably know even a little more than that, because I've mentioned the two proprietary tricks that I never divulge when I'm doing a demonstration for a large group of for a large online audience. Those two tricks are basically that when we do camouflage trades, we want patterns, ABCs, that have at least two single bar coordinates, either a good sharp A and C or a B and C, but in any case, C has to be sharply etched as a single bar on whatever time frame chart you're looking at. And the second piece of it, something that Lindsay never understood, but which is crucial to identifying opportune trades, is the impulse leg. So we need in camouflage trades for the AB leg to be a good, strong, totally legitimate, meets all our rules impulse leg. So those are the two proprietary secrets that separate out run-of-the-mill ABC patterns from ones we can expect to trade profitably. Here is the first instance of this slide was explicitly drawn to show a camouflage trade, and this is a pretty subtle instance of it. The trade was actually at this little red dot. That's where we got tripped in at X, and you can see that the impulse leg we're using, the ABC pattern, is a pretty good one. We've got a single bar, good sharp A, good sharp B. It got past a bunch of previous peaks, and what we like about it is that it got past these obvious highs that other traders are going to be looking at, by only 2/10,000ths of a point. Now, that's not going to fool the Elliott wave guys. You know, the Elliott wave guys say, hey, we've got an impulsive move. It's broken out above those highs, so it's no longer corrective. It's impulsive. But fortunately, most traders will be fooled. Most traders, when this thing starts pulling back to here, most of them are going to look at it and think, well, we've just got multiple tops there. We really didn't quite get through it. But again, we're not looking for quite through it or a little bit through it. Or a lot through it. Just a single 10,000th or 2/10,000ths of a point is enough to qualify this rally as an impulsive move, an impulse leg. So we get in there, and I did yesterday tell you that each time we trade, we want to rate it twice. We want to rate it going in, and we want to rate it after the trade. Going in, it's on a 1 to 10 scale. And this you have to calibrate according to your own trading ideas, your own trading instincts. But the 1 to 10 is based on your calculated odds that if you get in at X at this red dot, it's going to get you at least to P, the P midpoint of the pattern, where you can take a partial profit. You can take half of the trade off. So if you've got a more than 50% chance, if you think, if I get into X, I notice things are going to get at least to P, well, you might rate it an 8. And it did get to P, and as you can see, it slightly exceeded the D target eventually. All right, the other rating system that I suggested that you do with every trade is to rate the trade after it's happened. And that's on an A, B, C, D, F scale. And the grade's based on how much stress you suffered in the course of the trade. You got in here, and if it came all the way back to C, just a tick shy of stopping you out, well, it was testing your nerves. It was making you sweat a little bit. So even though you got in there and it eventually delivered, it gave you a profit, the fact that it took you all the way back down to C to test your nerves, that makes the trade maybe a C minus or a D plus. So a C minus or a D plus trade can be profitable, but we always want to use camouflage in a way that makes us suffer the least. We want to get in at X and just have this thing take off like a bat out of hell. And if it does that, that's an A trade, and it's telling us that. It's saying if you get in at X and the thing just goes your way exactly as you expected without noodling around, it's telling you that you absolutely found a great entry spot. You read everything correctly. And to finish the thought, the reason I emphasize this exercise is important, this grading system is important, is because it's the best way I know of for you to take these rules that I've been teaching you for 2 nights and eventually make them cohere as what you call horse sense, as market savvy, as market instincts. So it's an absolutely crucial exercise that will solidify your knowledge in a way that will give you a more instinctual feel for how to trade these things. All right, so a third thing that I want you to do with every trade is what I call a post-mortem. And a post-mortem, the patient doesn't, you could have made money, it could have been a good trade, but I always want you to think about the question, why did this trade work so well, or why did it work so poorly? So in this particular case, the question we might ask is, we got in at X, why did it take us all the way back down to C and make us sweat bullets before it finally took off? And there could be a lot of answers to that. The one that comes to mind for me is that the impulse leg was just a little bit too attractive. It's a good, strong, everybody noticed this rally, and some traders even noticed the fact that it got above these prior peaks. So it's a bit less subtle than the impulse legs that we know and love, the ones that we really want to use. So the post-mortem, the question is, why did we have to suffer just a little bit as this thing pulled back to C before it finally took off? My answer to that, the logical one, is because there were just too many bulls on board here. They had been enticed by this very promising, strong, distinctive, impulsive rally from A to B. All right, and let's see. All right, so we're looking at another camouflage pattern that has, you would look at this chart, and if I hadn't mentioned that this is a really good one, you'd probably be wondering why. What's good about it? Well, it's got a lot of things that we like. We've got this nice rally and a pullback, so we're looking to get long, and we're given that opportunity in such a beautiful fashion that we have to thank our lucky stars, because look at what this ABC pattern is in terms of the rudiments, the things I've talked about that we should be in love with. Number one, you've got single bar coordinates on all three ends. A is a stick down, discrete, all by itself, single bar. B is a stick up, high, single bar. So all three coordinates are single bar. The rally surpassed one internal peak right there, and this one is internal too, but you can see it's a little bit more stick-up-ish. It's a little more distinctive, and therefore it would have provided a little more resistance than this low. So even though technically they're both well, this is an internal. Let's call that an externalish internal. Just the same, we've got a nice rally through two priors, and what we particularly like about this trade is that the impulse leg did not break out above that high, which would have attracted too much attention. By and large, when we're doing these camouflage patterns, the numero uno rule is we're looking for impulse legs that don't look like anything. They look great according to our subtle and idiosyncratic rules, but you need to ask yourself, if someone else is looking at this rally, does they see anything special? And the answer to that is somewhat subjective, speculative. No, they don't see much happening here. We've got a chop, and when you talk about whether you see much happening, it's in a sense a visual evaluation of the bar relative to the ups and downs of prior bars. So considering this one bar here and this one bar here, this rally, it's not much. It doesn't really stick out that much. But even so, it's got everything we need. It's got one-off single bar A, single bar B, single bar C, got past two priors. And it did all that without giving itself away, without breaking out above that high, which would have attracted too much bullish attention. So, all right, let's move on here. This happened during an online impromptu session that I had, and you can see that we've got this downward move, and from the time of this bar, everybody here is bearish, everybody is looking to get short, and that's why it's just beating up on them. It's chopping around, and it's breaking down below previous lows, and it's breaking above previous highs. It's creating such trouble because everybody's bearish following that bar. Everybody wants to get short. We can go either way on this. We can find subtle ways to get short. You can see one little pattern: single bar A, double bar B, single bar C. We're short here. We've covered half at P and got stopped out. All right, but let's look. We're looking for any subtle opportunities we can find up or down, and as long as the crowd's totally 100% bearish, we might be thinking in the contrary way. Well, let's look for something going the other way. So the first place we see an opportunity that has the things that we need is right here. Along the whole way of this, all these bars, the first place where we see something that makes hidden pivot sense to us, camouflage sense, is right here. Single bar A, ugly, atrocious B, 3 bars, but we can live with it because we finally get a single bar C down there. So we've got everything we need. Single bar A, single bar C. It's a nice one-off A relative to that one right there, and it gets past the required internal and external peaks. Not only that, but it didn't go just a little bit higher to break above that peak which probably would have attracted a little more bullish attention. So it's a great little camouflaged impulse leg. You just don't see much power there. And by the time it pulls back to here and starts to rally, that's what are you waiting for? Don't think about what's going on here. Just get your buy stop in and do the trade. It got right away to the P midpoint where we could take half the position off. And you'll notice that the differential, we're in here and we're out of half the position there. That's just a couple of points. And you're thinking, well, geez, Rick, I mean, what kind of system is that if you're in and you take a profit on a 1.5 point rally? Well, the purpose of camouflage is not to make your fortune. It's to establish an entry position in the easiest places, to get on board with very little stress and very little risk. And if you're doing that, if you're looking for camouflage entry opportunities in places where bigger patterns say you should be expecting a turn anyway, then that fact will fulfill your goal of making big money on the trade. The camouflage piece of it is not really a money maker. It's the fact that you're getting on board for a potentially much larger move, but with the risk that is associated with the smaller pattern. So and your best opportunities are going to come from watchful waiting, very patient waiting, so that you finally turn up little gems like this one here. You know, it's worth waiting for hours. If you have to wait hours, that's what you're doing. You know, if you spend a whole day looking for one opportunity that produces a $600 profit, is it worth it to have suffered the tedium of the waiting, the watch? And of course, the answer is going to be yes. All right, here is an impulse leg. I've drawn it AB, and you can see the subtlety of what's going on. When you look at it, I want you to look at these impulse legs and ask yourself, well, what's everybody else seeing here? Is the crowd seeing a breakout here? Is the crowd salivating? You know, has something happened here that's going to get everybody all excited? And the answer is pretty much no. Because we do have, this is an impulse leg in our way of looking at it. It got past one external and just by a hair, a second external there. But other people are going to be noticing that it didn't break out above this high or the more important high right there. So it's just a rally. But in our way of looking at it, it's an impulsive rally that has an A, B, C set of coordinates and an X entry price. Here, I've drawn X. We typically do not want to use an X that occurs on the same bar on which C has occurred. But sometimes the trade will work so well that it's just going to happen. It's going to hit C and then start up so quickly and hit X so quickly that it's going to be on the same bar. So in practice, when it makes that low and starts to rise in a way that's about to turn that into a C low, if we get our buy stop in and get buy stopped in on the same bar, well, we could have worse luck than that, you know. But technically, I don't want to use X's that are on the same bar as C. In this case, it happened so quickly that we would have been triggered in and we would have been happy. You can see that on our A to F grading scale, when we got in at X, this thing just went. So it's obviously a good read. We picked a great spot to get in, as witnessed the fact that once the entry was signaled, it just went higher. It never noodled around, never pulled back at all. In fact, it moved so quickly, we would have been lucky to buy stop ourselves in at X. And that's typically going to be your best trade. You're so right that you barely have more than a few seconds or a minute to actually get your order in to buy stop your way aboard, or to sell stop your way in if you're shorting. Here is this is as subtle gets. Now, let me ask you where my point A is for the great trade of the day. And I'll ask that of both of you, and if you can just type in the in the panel there where you think the A belongs, whether it's here or here or here or here. There's such a beautifully subtle A that, again, it's one of those don't miss it, bet the farm. All right, and I don't know, it looks like we're kind of all right, beneath 1783. Yes, you got that. That's very good, Soresh. I'm assuming you mean this A right here. With all that's going on here, the subtlest impulse leg we could possibly ask for is right here. Single bar A, single bar B, and single bar C. That's the pattern. You said below 1783, so maybe you meant right here. But you're not too far off. The A of the month here is right here. And look at what we have. It's as subtle as we could possibly envision it happening, but we've got a single bar A there, single bar B, pulls back to a single bar C, and look what happened. When we got to that B there at 17.83, we surpassed not only this internal right here, but a slightly higher high at 1780 right there, an external. So just this short little segment here from that low to that high is about as subtle an impulse leg as you could find. Now, if you look at the bigger picture here, you sense that what's going on is we've got this thing going up, 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 and it's finally just slightly broken out above that, what had previously been the all-time high or multi-year high in silver wheaten. So you can imagine there's a lot of fear and panic there. It's like we've broken out just by a few pennies to a new all-time high. But what's going to happen? Is this going to be a bull trap or what? But we take this instance where panic and hysteria is driving this thing down, then up, then down, then up. And we reckon that price action not as panic, but as just an impulse leg. Single bar A, single bar B, got past one internal and one external. We also like the fact that when it pulls back so far that it almost breaks the uptrend. It almost takes out the point A. But the fact that it didn't, and it starts up again in a way that tells us that, hey, get ready, it's about to trip our entry signal, you needed to be right on that entry signal right there, and just believe in it. It looks like this played out, actually is not like 5, 10, 15 seconds where you've got to do all this. This played out over several days, but my suspicion is that the day where you caught the rally, it wasn't easy to get at the opening bell. You probably had to watch things move in helter-skelter before you were in. So you had to be in the day before this happened, and you couldn't ask for more subtlety right here. All right, and as a practical point, I'll mention that once we had the impulse leg on day 1, 2, 3, that's 3 days of action, and we pulled back for the next 2 days, and then the third day it looks like we opened we opened above where you would have been tripped in long. Well, the mere tripping of that long signal on the big pattern. The big pattern here is, believe it or not, this small thing, A, B, C. But the entry pattern we might have used would be in these last couple of bars before it took off. We would have gotten down on maybe the 15 or the 5-minute chart to find ourselves in the X entry point right in there. But we're justified in looking for camouflage at such point as the larger pattern trips an X entry signal. So from that happened about here. So anything over the next couple days, if we were looking for a way in, it should have been from the bullish side. And I do get an indication here when I've got somewhat less than absolute attention. So if you're using a third-party application or just kind of noodling around, this is all pretty important stuff. As you can see, it's all in the recording, so you'll be able to get it tomorrow, but be easier on you if you get it the first time around. All right, I have something, it's called an audience view, and if everybody's listening and not noodling around with the third-party application, it's all green. But if people are screwing around with Word or Outlook or whatever, I get a lot of red there. All right, here is a sequence of charts that shows how we come to frame a camouflage opportunity. Now, the first thing I mentioned before was that we look for camouflage in patterns of higher degree. In other words, if we find a major turning point, let's say a D target, a rally target that's been 3 weeks in coming, then if we're looking for camouflage, we're essentially shooting, swinging for the fences. We're trying to catch a major high, but using a very small pattern with small risk. But the bigger the pattern that's giving you your prospective turning point, the more likely you are to have success with your camouflage entry. So here, the bigger pattern that we're looking to trade is this ABC that gives us a P midpoint at 1156.50. So we want to come down, down, down. It's coming down, 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 and it approaches the target. And when it gets within a point or so of it, we want to get down to a target, a chart of lesser degree, because the idea here is to, the old style Rick's picks, we used to simply bid 1156.50 with a 3-tick or real tight stop loss. And I recognized over time that this was a pretty stressful process, that you really had to know your stuff to have the confidence to be down there bidding against something that's falling, falling, falling. You're catching a falling safe right there, and to have confidence about doing that, you have to do it a lot. You really have to, it takes work. So I invented camouflage because, in part for that reason, that it was an easier way to get on board. You didn't have to sweat bullets, but also because my two trading partners, John Boudiette and Steve Hauk, said, Rick, hidden pivot method's great for managing risk and great for exiting a trade, but we're just not finding enough great entry points. So camouflage is essentially Lindsay's idea, but with those two proprietary secrets that I gave you earlier. So with that in mind, we look at this pattern, and I'm assuming it's within the context of a larger bull market. So we've got a corrective pattern here, and we've got an ABC that we don't expect to hit D. We have a good chance of getting a bullish bounce from P, simply because P is part of a corrective pattern in a larger bull market. So the old style Rick's picks, we might have missed the trade. We might have been 1156.50 bid, and it could have turned from 1157, and we would have missed getting in by a single tick. But with camouflage, we're really just sort of coming alert when the opportunity gets near. So if we're expecting a turn from 1156.50, when we get down to around 1158, 1157.5, we want to zoom down to a lesser chart, in this case the 2-minute. Keep in mind, this is where we were looking for the turn, 1156.50. It overshot it by a little bit, maybe enough that if we were using old style limit bid and a tight stop loss, we might have gotten stopped out there. But if we're doing camouflage, all right, we're looking for the turn somewhere around there. And the first place the turn, the bullish reversal, becomes manifest visually in a way that we can trade it is right here. We've got a bullish impulse leg. And it's nice. It's got single bar A, potential single bar B, and it got past a good, legit internal peak there and a good, legit external. It even got past a second external peak, and that's not to the good, because in getting past that peak, it's going to attract, the impulse leg is going to attract a little more bullish attention, but it still looks pretty good. And because we're expecting a big turn, major turn from down around here anyway, we have this, it's logical to think this thing's really going to go. It's just, it's hitting a major support down there, and it's just going to go. So So we watched to see how a couple more bars played out. And from our standpoint, it's absolute perfection. It's a single bar A, single bar B, single bar C. You had to be quick, though. You didn't have time when this thing started to rally and thereby create an X entry point. It happened quickly enough that we had to act very quickly. So if we worked on it, and it paid off for us, because you can see that the second leg up is happening so quickly that relatively few people would have had a chance to get on board. There wasn't much of a correction here, BC, before this thing started up again, and gave us what we were looking for. So in this case, we do have an impulse leg that's pretty obvious. It's going to attract more bullish attention than we would like, but there's enough buying power driving it that it just hits X and keeps going, even though there are a lot of bulls on board making money. It just happened so quickly that's what made it happen. That it caught most traders by surprise. And I'm going to introduce a new idea right now called the time buy stop. And let's see. I'm still a little distracted by my indicator that we've got some noodling around with a third-party application, but again, I'm going to strongly suggest that you pay close attention here, because these concepts are pretty subtle. All right, so I know, Suresh. All right, so I'm going to introduce a concept here called the time buy stop. And a time buy stop is an entry tactic that you want to use if you've got a pattern that you like, but for whatever reason there's some uncertainty about it. And in this case, if there were any uncertainty at all about jumping in at X, it would come from our just mild fear that the impulse leg is a little bit too noticeable. It's a little bit too strong. It's going to attract a little bit too much bullish attention. So if that was the thought in the back of our heads before we entered the trade, we could still test the water by way of this time buy stop. We could basically say, okay, I'll stop myself into the trade. I'll buy it if it hits X, but I'm only going to stick with it for 10 or 15 seconds. If it just noodles around and goes nowhere, I'll stop myself out. Usually, and usually if you've got any pattern that looks half decent, it's not like it's going to hit X and just drop like a stone. It's probably going to hit X and it'll hesitate for long enough that if you want to get out, you can probably get out for a scratch, or maybe you'll lose a tick or two. So the idea of the time buy stop is, in this case, you're just a little bit hesitant about taking the X entry signal because the impulse leg is just too noticeable. So you use the time buy stop. You say, I'll get in, but I'll only stay in for 10 or 15 seconds, and if it doesn't get me in the black in a hurry, I'll exit the trade. In this case, nope, everything worked perfectly. You got in and it just went higher. So always consider that time buy stop if you think that there may be something about the pattern that you're trading that could cause it to hesitate at X. And again, you're not going to give up much. If your pattern is even half decent, you're not going to give up much. If you wait your 10 or 15 or 20 seconds or 30 or 60 seconds even, and it goes nowhere, you're generally going to be able to get out for either a very small loss or a scratch, maybe even a small gain. All right, so you see the pattern continued, and we were in at X. It got us to P. And keep in mind that P is that place where we can take a small profit on the trade. It's a good place to put yourself in that psychological comfort zone that I talked about. Just take a little bit of money off the table, and you're going to get the rhythm. You're going to get the feel for what's going on. You're going to be relaxed in a way that will let you trade better. It'll be like a stare dancing with Rogers. So in a camouflage trade situation where we actually get from X to P, I call that a successful trade. And in a camouflage, and we would take off half the position there. And as you may be able to appreciate, if we take off half at P, we've lowered our break-even point from X down to C. So this thing could fall all the way back to C, and we still wouldn't have a loss. So that's one of the big reasons we take a small partial profit at P, because it gives us a little more flexibility in the use of our stops. And if it gets from P to D, and I always assume 4 contracts or 400 shares, because that makes it very easy to take partial profits and nice round numbers. We're in at 400 shares there. We exit 200 shares for a small profit there. And you see in the next slide, it just eventually got us to D and beyond. And a camouflage trade that gets us from X to D is what I call a winner. All right, so a successful trade is getting from X to P, and getting from X to D, or P to D, is a winner. And when we get to D of the small pattern, of the camouflage pattern, you want to take off a third quarter of your trade. So you sell another 100 shares there. And at that point, here, you've got 100 shares left from an original 400 acquired down there. And you don't have much of a profit, but you've got enough of a profit that you can just ride with it. And you remember yesterday's little lesson on the impulse leg based stop loss. So we're long 100 shares there. And if we want to, well, not swing for the fences, we might say I'll stop myself out only if it breaks below 2 prior lows of 5-minute degree. But here we'll use a fairly subtle trailing stop. We're long 100 shares. Let's stop ourselves out if we get an impulse leg to the downside on this 2-minute chart. We don't get it here because it went past one kind of internal there, but no externals. We get another rally, and the first place where we might have an impulse leg is from there to there. Got past one internal, but no externals. So we're still long. And you can see at no point along the way would we have gotten stopped out if we applied an impulse leg stop loss based on the 2-minute chart. We never had a downtrending move that took us below 2 prior lows without an intervening correction between them. I did mention that a good rally, one that is likely to continue, should make a new impulse leg with each thrust. And in this case, we've got a thrust from here to here. That's not quite impulsive, actually. We've got a thrust from there to there that is impulsive. It got past internal, internalish, external, bunch of externals there. And the next thrust takes us through an internal and an external. So this is doing what it should. On each successive thrust higher, it's getting past at least one prior peak. Here we've got a look to the left or an external, but you really had to be quick. You know, we've got good, nice, pretty single bar A, B impulse leg, pulls back. We might have gotten triggered in there, and from the point it stops you out, you better not be licking your wounds there, because you better be able to be ready to pick yourself up and do it again, and be ready for that second signaled X, because that you can see that the second one is the charm here. And this goes back also to something that I said, to do a post-mortem here, like why did it trigger us in there and then stop us out there? Well, the answer is pretty obvious here, because the impulse leg is so noticeable, it's so strong, so distinctive, that everybody waits for the pullback, and as soon as it starts to move up again off some low, they're all jumping on it, and that's why it stopped everybody out right there. Here is, you can see that going to the left side of the chart, when we come over here and start making impulse legs, that there's a lot of toppiness. And the very interesting thing, this is probably about as subtle an instance of what I'm showing here, as you're going to see. But we've got a nice impulse leg right here. Single bar A, single bar B, and eventually single bar C. I came back to test C. Actually, this bar looks a little lower than that. That's our actual C. All right, so the key here, look how beautiful the impulse leg is. Again, when we look at an impulse leg, the foremost question on our minds should be, what does everybody else see here? Do they see a breakout? Do they see the beginning of a fabulous rally? Whatever. In this case, what they see is a high here that didn't break out at all. It actually fell in that single penny zone between this high and that one. You couldn't ask for, this is beautiful camouflage because it really isn't a breakout. It didn't get above that high. Everybody's reading it as a multiple top with these guys. But in our way of looking at it, it's absolute perfection. It's single bar A, single bar B, eventually single bar C right there. It got past one well-defined internal, and it got past a genuine, legit external there, but without breaking above another external. So this is such good camouflaged impulsiveness here that we shouldn't hesitate to simply jump on it at X. In terms of our grading system, A, B, C, D, F, how much stress did we suffer after we got in at X? Well, none. It looks like it never went lower than X. We got in there, went a little higher, came back to X on the next bar, but never did it take us all the way back down to C to test our nerves. We got in and it simply went higher. We're out a half at P, and of course eventually got us way beyond D. So wound up being a good trade. And the fact that we're in at X and it did what we wanted it to do, and it did it without any hesitation, it's telling us that we read the opportunity exactly, perfectly, correctly, just as I described it. We've got this high that did not attract the attention of it would have by breaking out above all of these peaks. It actually topped in the middle of the two, which it makes it kind of a non-event for most traders. And then from the point, you can see X and C are on the same bar here. So again, you've got a considerable opportunity that comes not merely from just reading a pattern and doing your hidden pivot work, but having the speed to get your X, your buy stop entry right there, rather than think too hard about what's going on. If you see that low and it starts up, even though it may not take 2 minutes to get you to the next bar where you can get an X that's not on the same bar as C, here, if you'd simply been ready, if it starts moving up and you quick get your buy stop in, you would have been in there and it would have been a great trade. And one of the reasons it worked was because you and everybody else would have had such little time to get your buy stop order in. TradeStation's a good platform for that, and I expect that many of the ones that I haven't used, I've worked with the CQG's platform, with the Real Ticks platform, and Ensign, but I expect most of them at this point have chart execution skills where you can execute the trade by using lines that you've drawn on a chart to trigger the trade, and that's a very, very good thing. And you'll know if the TradeStation platform, and I would guess other platforms as well, has some macro keys where you can set up exactly the parameters that I've been telling you, which would be, enter on 400 shares, and at that instant you put a sell stop on all 400 just below point C. You make that one cancels the other with getting out of half the position there, and you can do that with just one macro setting. You just pull down, and I'll show it to you on TradeStation when we get to the platform. But you can do all those things. You can say, buy stop myself in on 400 shares if it hits X, and at the instant it hits X, put a sell stop on all 400 shares below C, and make that one cancels the other with an order with an exit order, a closing sale at 38.91 at point P. And Suresh, you use Trade Navigator Gold. Does it have that capability? Because all right, so that's good, because again, your ability to actually execute the trade to get it done quickly is going to be heavily in your favor, to the extent that many of these opportunities unfold too quickly for a lot of traders to get on board. All right, here is I'm going to jot down Trader Navigator Gold, because I want to take a look at it myself. I'm always looking for platforms that make it easiest to do what we do. All right, here is another instance of the subtlety that you need to take advantage of. We've got the dotted lines represent hypothetical price action that I've drawn in. And you can see that we've got a beautifully impulsive rally, single bar A, single bar B, got past internal, and just by a hair, an external right there. And it's breakoutish enough, and the impulse leg is distinctive enough that we might expect that if it's going to work, it's going to happen pretty quickly. In other words, we better not expect a pullback and a lot of noodling around. When it pulls back and starts moving back up again, we should definitely have our buy stop in, even if we're doing it on a time buy stop basis. All right, and I will demonstrate, I will show you to some of those macro keys when we get on the platform, Armistead. All right, so, all right, here, I want you to, again, appreciate the subtlety of the opportunities that you would seize upon. Here, I've drawn in a little, very subtle, short AB impulse leg, and it got past an internal there, and it got past maybe that peak as well. But it also, let's see, I'm going to assume, it doesn't really look like it's drawn that way, but I'm going to assume that our B got past this teeny tiny 1623.80 peak. And keep in mind that that peak there, that sharply drawn external, as tiny as it is, it's as important as this one and this one and all the others, simply because it meets our rules. It's a fully fledged external peak, and the fact that any rally that gets past it and pulls back is dropping money in our laps. The importance and usefulness of this peak right here is that it gives us a reference point to define an impulse leg. Any rally that we get that surpasses that and pulls back gives us the ABC that we need to work our magic. All right, here is, and I think this looks like the same chart. Maybe it's not, but in any case, you can see that I mentioned earlier that our opportunities really come from external peaks that we can use to reference ABC rallies on the other side of the chart. So to the extent that we've got that little external right there, we want to use it. And to use it, as we're rallying, we want to see the first instance of the rally that actually gets past that peak right there. So we're looking at the peak. The peak is the first thing we see. It's the most important possible opportunity that we have. And we want to pay close attention to whatever rally segment finally and firstly surpasses that high. And it happens right here. So when we get a little bit of a pullback, we've got everything we need really for a tradable pattern, A, B, C. Just be sure you're quick getting your buy stop entry in. The camouflage tactic is fantastic for picking opportunities out of what you see here. Now, what you see here is really just a mess. It's a bunch of price bars that most traders would consider untradeable. It's like it's just chopping around. Looks like a consolidation to take it higher. And if we all know that, if we know it's a consolidation and it's going to go higher, it behooves us to find some low-risk entry price within the thicket of these price bars. So lo and behold, if we spread the bars out a little bit, instead of seeing a forest, we now see some very useful trees. And there are numerous entry points. We had here you can see just by the thinness of these bars, by their sketchiness, that this was trading in the wee hours of the morning. Nobody's really in there. But when the bars start thickening a little bit, we get a sense that more traders are starting to wake up. They're becoming active. And from all of this here, the first place where we see what we're looking for, a good impulse leg to trade, is right here. Single bar A, double bar B, single bar C. It got past one internal, second internal, and I'm not sure about that one. Maybe, I don't know whether it got past it, but it got past two prior peaks. So it's like, what are you waiting for? Don't think about it. Just buy stop your way in at X and ride 'em cowboy. All right, so we had a boring hour and a half here after we got in. And with all this chopping around, we're still long. We might have gotten 4 contracts there, out of 2 of them there, out of 1 there, and we're just sitting with 1 contract, essentially prepared for the blast off out of what we saw in that first slide as a nasty, vicious, inscrutable consolidation pattern. So we're long 100 shares in what we consider to be, what we speculate as being a consolidation pattern. So we might get stopped out, but it's so easy for us to get back in that we don't mind stopping ourselves out and saying, this is just too boring. Let me try entering on the next opportunity. So the very next opportunity that meets our rules is right here. Double bar, ugly A, but a good clean single bar B, single bar C. It got past 1, 2 prior peaks and looks like maybe even a third right there. What are you waiting for? You just buy stop your way in. And yes, this was a C minus or a D plus trade, because once you got in at X, it took you all the way back down to C. It tested your nerves a little bit. Why? Well, we want to do a little post-mortem there, because this impulse leg, in the context of all the little crap that's going on before it, this impulse leg is kind of noticeable. So to the extent that's true, that's why it managed to get us in at X and take us down to P to test our nerves. If there had been more traders and more nervousness there, for sure this thing would have gone the extra tick to stop them all out. But the fact that it didn't gives you one more post-mortem fact to infer or to speculate on, and that is that there's some bulls on board here, but they're not a bunch of nervous Nellies. They're good seasoned traders, and they're disciplined, and they're not going to stop themselves out unless this thing actually goes beneath that low. So we don't have a lot of nervous traders there. Otherwise, it would have taken them beneath that low, but it didn't. So it finally took off, and as you can see, we're in the trade. We're out of half there, another half there, or another 25% there, and we'll just stick with the single contract as we get to just prior to the opening. And it's a great way. We're in the middle of the night there, or in the very early morning, and ready for the onslaught. If everybody comes hungry to the opening bell, this thing could be up on a gap that would give you some instant profits. Here is another camouflage idea that's going to be useful to you. We're kind of chopping around, and we come down. Everybody sees that low, and every trader on earth is looking at that low as possible support, and they're sort of guessing as to when they should try buying it ahead of this thing testing the support. But we have 2 ways to do it that are not just guessing games. They're very subtle and precise ways. We can use an A, B, C pattern to buy at the P midpoint. Or if, like everybody else, we're expecting a bounce from somewhere above that low, we can wait for that bounce to become manifest as an impulse leg that we can trade and just look at it. Single bar A, single bar B, got past one external, second external, buy stop yourself in at X. It's like, what are you waiting for? Don't think about that trade. Just get your buy stop order in and take the trade. All right, I'm going to pause the recorder and right now.